All right, real estate investors, let's talk about a game changer in the world of financing your investments, DSCR loans. You might be wondering what exactly is a DSCR loan and how can it boost your real estate portfolio. Let's dive in. First off, DSCR stands for Debt Service Coverage Ratio. It's a metric that lenders use to assess whether the income from your investment property is enough to cover the mortgage payments and associated costs. Simply put, it's net operating income divided by debt service, or your annual mortgage payments. A DSCR of 1.0 means your property generates just enough income to cover the debt, but lenders usually prefer a DSCR of 1.25 or higher. This means your property should generate 25% more income than needed to cover the debt. Now, let's talk qualifiers. First up, the property's cash flow. Your property needs to generate enough income from rents or leases to cover the mortgage and other expenses. This is crucial. Many lenders require a minimum DSCR of 1.25, but it can vary based on the lender and property type. Next, the down payment. Typically, you'll need 20 to 25% down, but it could be more depending on the property and your creditworthiness. A higher down payment can sometimes get you better terms like lower interest rates. Speaking of credit, while DSCR loans rely less on your personal income, a good credit score still matters. Most lenders look for a score between 620, 680, but higher scores like 700 and above can get you even better terms. Also, you'll need to be mindful of the loan-to-value ratio, or LTV. DSCR loans usually require an LTV ratio of around 75 to 80%. This means you'll finance 75 to 80% of the property's value, with the remaining 20 to 25% coming from your down payment. Lenders prefer income-generating properties like rentals, multifamily units, or commercial real estate. These properties should have a proven rental history or be in areas with strong rental demand. You might also need cash reserves, typically 12 months of mortgage payments, to cover any potential vacancies or dips in rental income. Experience in managing rental properties can be a plus, especially for larger or multi-unit investments. Some lenders prefer borrowers with a track record in property management. An appraisal will be required to assess the property's value and its potential to generate income. Lenders need assurance that the property can maintain its value and provide consistent cash flow. Documentation is key. You may need to provide rental history, lease agreements, or rent rolls. If it's a newly acquired property, you might need to show the market rent for the area. Lastly, let's talk interest rates and terms. DSCR loans often come with slightly higher interest rates compared to conventional loans due to the higher risk for the lender. Rates can vary based on your down payment, credit score, and the specific lender's guidelines. So who benefits from DSCR loans? Real estate investors looking to acquire rental properties without relying on personal income for qualification. Entrepreneurs or self-employed individuals who might not have easily verifiable income. And investors seeking flexibility in financial assessments. There you have it. DSCR loans can be a powerful tool in your real estate investment strategy, offering more leniency than traditional loans and helping you grow your portfolio. Thanks for watching. If you found this video helpful, give it a thumbs up and subscribe for more real estate tips.